So obviously interest rates have increased for the first time in nearly 12 years. They went up from a very low of 0.1% and they increased by 0.25% to 0.35%. Nearly every bank passed on 0.25% increase to their clients. What that means to the average person is for each if you're on a variable home loan and you're paying principal interest, each $100,000 that you've got borrowed, you'll now be paying an extra $4.80 per week in interest cost and repayments. The history of it is that the 0.1% that the Reserve Bank had set previously was artificially low and was very low. And that was because they were trying to, nurse the economy through COVID and all the things that were happening around the world at that time. At the moment, the Reserve Bank and the government are afraid that inflation is starting to happen. And it's not just in Australia. If you look at overseas news, it's happening around the world. And psychologically and financially, that can have significant impacts for the economy. And so the Reserve Bank is increasing interest rates in an attempt to slow down that inflation and to bring prices back, more to a more stable level. At the moment, there's some really wild predictions out there of interest rates, going to very, very high levels. Some people have talked about, 17% in the early 90s and that kind of stuff. Because the Reserve Bank hasn't done anything for 12 years in terms of raising interest rates, it seems to me that they would take a more measured approach and they might increase interest rates once, twice, 3 times and then more considerate, rather than going hell for leather and doing 10 times in a row. But it does seem that there are more interest rates to come, and so it'll be interesting to see how that plays out over the next few months. So the answer, of course, to this is it depends. So the first question is if you're asking me, can I beat the bank by fixing? So a lot of people, when they ask me this question, they're actually asking, look, am I going to make money or pay less interest by fixing my loan at the moment over going variable? So they're looking at going, here's fixed, this is what I pay, here's variable, and they're going, if I fix, I'll pay less. The challenge with that is that both of those outcomes are reliant upon a bank being on the other side. So when you fix your loan, Commonwealth Bank, ANZ, etc., they are the bank who's setting those interest rates for you to fix it. And those banks are some of the biggest and most successful companies in Australia, and a lot of banks, some of the biggest companies in the world. And they don't get to be that big and successful and make all the money that they do by letting, a mortgage broker somewhere go, yeah, fix, and you'll beat them. It just doesn't work that way. So what we suggest to do is there's a couple of rules around fixing. The first one is if you do fix, you should have keep a chunk of your loan that is going to stay variable. And that's because you have some flexibility there to pay that loan off, make extra repayments into it. You also might have an option where you have either redraw or an offset account against that loan, which will reduce how much your interest you pay. And the last thing is if you pay extra into a loan and then in the future you need that money, with a variable loan, you can draw that money back out so it can help with your budget. Whereas if you've got a fixed rate loan and you're paying extra money into it, it's nearly impossible to get that money back out again without breaking the loan, and also things like offset account and redraw don't work. So that brings you back to why you should fix, and that is a personal question, and it's usually based around your individual family situation. So rather than going, when we answer that question, rather than thinking, am I going to beat Commonwealth Bank at this? The question to ask is more over the next 2 to 5 years, if I fix my loan, does that give me a good level of certainty for my home and for me personally, so that I feel comfortable for that period of time that I can comfortably make repayments? So for example, You know, you might have bought an investment property, so all of a sudden you've gone from having just a home loan to now you've got a home loan plus an investment loan, and you might look, be concerned about all the debt that I've got. You might go, if interest rates rise, how am I going to pay for it all? And you might go, okay, if I fix a portion of this, that's going to give me certainty over that part of the debt, so I can handle if the other one changes. At the moment, if you look at the fixed rates are significantly higher than the variable rates. So as soon as you fix, you are paying a chunk higher, and in some situations that's nearly 2% or higher than what the variable rate is. So what that means is if you're paying, for example, 2.5% here, but you fix at 4.5%, straight away you're paying the equivalent of 2% higher. Now 2% is 1/8 of an interest rate rise. So you're paying it straight away. So in effect, for you to beat the bank, so to speak, the interest rates have got to increase very quickly, and they've got to increase more than 2% for you to be better off fixing. If they only go up by 1%, for example, 1.25%, and then the Reserve Bank goes, oh, you know what? We don't have to raise them as much anymore, or it slows down, or everyone's view of the world inflation changes, then all of a sudden you'll be stuck at a higher interest rate, paying a higher repayment, then the variable will have sort of eased out. So it'll be very interesting to see what happens. But if you want to talk about this more individually, please reach out and let us know. First thing is not to panic. In spite of all the stuff that's being written about it and the very strong words about it, it's not going to change the situation. Okay? So, and panicking rarely helps anything ever get done, as everyone would, know. But what we can do now is look at what we can do to get prepared. So what it is if there's stuff that you can do to, cut your costs, on say a $500,000 loan, the repayments are going to go up by approximately $25 a week. All right. So most people will have something that they spend money on that they can either reduce the spending of that money, or they can make extra savings in order to do something to cover that. All right, for the first one. All right. This is a good period to reduce or review your finances and your budget and where you're spending money. And sometimes, it can be cutting down on subscriptions that you might have for Netflix or Disney Plus, etc. Maybe, have them for a few months and then stop them, and instead of having 2 or 3 at one go, have them in blocks where you have them for 2 or 3 months and then cancel it. A lot of things these days are on subscription. Companies love billing you every month or something, and a lot of people, even if they don't use it very much, they'll still happy to pay the direct debit. So maybe look at cancelling a few of those. If it's something that you're really concerned about yourself, like your family situation, and you want to have it would help to have a talk about your situation to sort of see what steps you can take. As always, you can book in a phone call. Happy to do that and to talk you through what's happening and what you can do. And be prepared for the fact that there probably are going to be a few more rate rises. Whether they come as quickly as everyone's saying, whether they'll take some time, will be interesting to see. But we're always here to talk about it if we can help with it.